Here is a thought worth sitting with. The global cryptocurrency market is now worth trillions of dollars, yet on this Thursday morning, the 16th of July, 2026, the vast majority of retail participants are still making decisions based on social media sentiment rather than structured research. That gap between noise and evidence is exactly what this analysis is designed to close. Welcome to your daily crypto market breakdown. Today we are examining Bitcoin's current position in the post-halving cycle, altcoin sector dynamics, regulatory tailwinds, institutional capital flows, and the on-chain metrics that serious analysts use to cut through the speculation. The crypto market operates around the clock, and by the end of this video you will have a clear, research-backed picture of where things stand as of today. Bitcoin remains the single most important asset to understand if you want to make sense of the broader crypto market. We are now more than 2 years past the fourth Bitcoin halving, which took place in April 2024 and reduced the block reward from 6.25 BTC to 3.125 BTC per block. Historically, the 18 to 30 months following each halving event have represented Bitcoin's most significant price appreciation windows, a pattern consistent across the 2012, 2016, and 2020 halvings. That places mid-2026 squarely within the period that on-chain analysts have been monitoring most closely. Layered on top of that cyclical context, the approval of spot Bitcoin ETFs in the United States in January 2024, products launched by BlackRock, Fidelity, and Invesco, among others, fundamentally restructured Bitcoin's demand profile by bringing regulated, institutional-grade access to the asset. The daily inflow and outflow data from those ETF products is now one of the most watched metrics in the market, and understanding what institutional buyers are doing on any given day provides retail investors with a critical directional signal. Beyond Bitcoin, the altcoin market presents a more fragmented picture, and that complexity is precisely where disciplined research creates advantage. Ethereum, which completed its transition to proof-of-stake via the merge in September 2022, saw its investment case shift substantially again following the approval of spot Ethereum ETFs in the United States in the summer of 2024. The combination of Ethereum's staking yield mechanism, the deflationary fee burn model introduced by EIP 1559, and the expanding Layer 2 ecosystem, including Arbitrum, Optimism, and Base, continue to factor into how analysts assess ETH's valuation relative to Bitcoin at this stage of the cycle. Across the broader altcoin market, performance is diverging sharply by sector. DeFi protocols, competing Layer 1 blockchains, and real-world asset tokenization projects are each responding differently to current macroeconomic and liquidity conditions. The research signals worth tracking here are developer activity, measured by GitHub commits and protocol updates, and total value locked, or TVL, across on-chain protocols, as these lead speculative price action and indicate where genuine utility is being built versus where capital is simply rotating on momentum. One of the most consequential structural shifts in cryptocurrency over the past 2 years has been the progressive clarification of regulatory frameworks across major economies, and this is a development whose market implications are still being priced in. In the United Kingdom, the Financial Conduct Authority has continued expanding its crypto asset regulatory perimeter, bringing digital asset businesses increasingly within formal oversight standards covering financial promotions, custody requirements, and anti-money laundering obligations. In the United States, the passage of clarity legislation defining which digital assets qualify as commodities under the CFTC versus securities under the SEC resolved one of the most significant sources of institutional uncertainty that held back capital deployment during 2022 and 2023. Across the European Union, the Markets in Crypto-Assets Regulation, MiCA, came into full effect in 2024 and created a harmonized licensing and disclosure framework applicable across all 27 member states, reducing friction for European-domiciled crypto businesses considerably. Regulatory clarity matters enormously for price because it reduces the risk premium that investors price into assets facing legal ambiguity, and the clear global direction is towards integration of digital assets into formal financial frameworks rather than outright prohibition. The story of institutional adoption in cryptocurrency has moved decisively from a future narrative to a present market force, and its effects are visible in daily price action. The suite of spot Bitcoin ETF products in the United States has collectively accumulated substantial Bitcoin holdings since launch, and the net flow data published each trading day is treated by analysts as a leading indicator of near-term price direction. Beyond ETFs, publicly listed companies including Strategy, formerly MicroStrategy, have maintained large Bitcoin treasury allocations as a macro hedge, a strategy that other corporates have partially replicated. Some sovereign wealth funds and insurance companies have disclosed modest allocations to Bitcoin as a portfolio diversifier, particularly in the context of sustained concerns over fiat currency debasement and persistent long-term inflationary pressures. For retail investors, the critical implication is that the old assumption of crypto as a purely retail speculative market has been invalidated. Institutional participation deepens liquidity and raises market sophistication, but it also means that macroeconomic releases, central bank interest rate decisions, CPI inflation prints, non-farm payrolls, now move crypto prices faster and more sharply than they did 5 years ago. One of the most distinctive advantages cryptocurrency investors have over participants in traditional asset markets is free, real-time access to publicly verifiable on-chain data. The blockchain is a transparent ledger, and the aggregation and interpretation of on-chain signals is now a discipline in its own right. Several metrics deserve specific attention today. Bitcoin Exchange Reserve, tracking how much Bitcoin is held in wallets controlled by centralized exchanges, is a key supply signal. Declining exchange reserves historically indicate holders are moving Bitcoin into self-custody, tightening liquid supply and correlating with upward price pressure. The MVRV ratio, which divides Bitcoin's market capitalization by its realized capitalization, effectively the total acquisition cost of all coins at the price they last moved, provides a historically reliable framework for assessing whether Bitcoin is expensive or inexpensive relative to its own cost basis. A ratio above 3.5 has historically preceded cycle peaks, readings near 1.0 have marked accumulation floors. Additionally, Bitcoin's network hash rate, the total computational power securing the chain, has reached levels in 2026 that reflect sustained miner confidence in long-term network value, which is a structural signal of chain health that price action alone cannot convey. Looking at the near-term outlook from today, Thursday the 16th of July, 2026, the picture is shaped by several converging forces. The monetary policy trajectory in the UK, United States, and Eurozone remains the single most important macro variable for risk assets including crypto, as the appetite cycle for digital assets has shown clear sensitivity to interest rate expectations. Any movement toward looser monetary conditions, rate cuts, quantitative easing signals, or softening inflation data, has historically been constructive for Bitcoin and risk assets broadly. On the supply side, the post-halving reduction in newly mined Bitcoin continues to work mechanically in favor of the long-term supply-demand balance, as approximately 450 new coins per day are now issued versus 900 pre-halving. The continued maturation of Ethereum's Layer 2 scaling ecosystem is expanding the practical throughput and cost efficiency of decentralized applications, supporting the fundamental utility case beyond speculation. Risk factors to monitor include counterparty concentration risk on major exchanges, geopolitical events that could trigger broad risk-off sentiment, and the pace of regulatory implementation in jurisdictions that have not yet finalized their frameworks. On balance, the structural tailwinds, institutional integration, regulatory clarity, and post-halving supply dynamics continue to support a constructive view for patients, research-driven investors. Let us close with the concrete, actionable conclusions from today's research breakdown. First, the post-halving cycle framework places mid-2026 in a historically significant window. Understanding where we sit in that cycle is your primary navigational tool. Second, spot Bitcoin ETF daily flow data is publicly available and worth monitoring each trading day. It tells you in real time what the largest, most informed institutional capital pools in the world are doing. Third, on-chain metrics including Bitcoin exchange reserves and the MDRV ratio are free to access through platforms like Glassnode and CryptoQuant, and they deliver genuine informational edge when applied consistently over time. Fourth, regulatory developments across the UK, EU, and US are broadly constructive for the institutional case, but individual token risk remains high. Distinguishing sound blockchain infrastructure from purely speculative assets matters more in 2026 than it ever has. And fifth, position sizing and portfolio diversification across the crypto asset class, combined with defined risk parameters, separates investors who survive multiple market cycles from those who do not. Do your own research, verify every claim you encounter, and make decisions on data rather than hype. That distinction between evidence and emotion is what this channel is built on. Thank you for watching today's analysis, subscribe for daily market breakdowns, and we will see you in the next one.